Do you know that banks and financial institutions don't follow the same ITC rules that other businesses follow? And there's a very practical reason behind it. In regular business, when you have both taxable and exempt supplies, you must identify common ITC and reverse the portion relating to exempt supplies. But banks and financial institutions deal with huge volumes of transactions and most of which involve exempt interest income. Tracking and proportionately reversing ITC for thousands of daily transactions is very impossible. So, to avoid this never ending calculation burden, GST introduced a special optional method, especially for banks and FIs, and that's where this Rule 38 comes in. Instead of doing complex monthly reversals, they can choose a straight rule, that is, claim only 50% of their eligible common ITC and the remaining 50% is not allowed and must be shown as reversal in the GST returns. Let's now discuss few important points with respect to Rule 38. Once they choose this method, they cannot withdraw it for the rest of the financial year. It must be followed consistently. This 50% restriction does not apply to supplies made between two registered persons having the same PAN, meaning branch to branch or unit to unit supplies under the same PAN are fully eligible for ITC without this 50% restriction. How this 50% ITC is calculated? Before applying the rule 50%, they must remove block credits, remove credits not related to business, keep only common eligible ITC, then from that common eligible ITC, 50% can be claimed and 50% must be reversed. So in short, instead of doing complicated reversal calculations every month, banks and FIs get a clean optional rule, take 50%, reverse 50% and move on. Save this video, stay tuned to SBK tax classes for more simple and practical GST explanations. Thank you.